Only mode.
Good afternoon, everybody. Today we're looking at business combinations. We did discuss business combinations last year in June. This webinar takes a slightly different approach, so it's not a duplication of what we've done in June. And you'll see in the slides I do provide a link or an address on where you can access the webinar presented in June. If you if that's not working, you can also go on the Picture Partners YouTube channel and watch the webinar there. So that was a business combinations webinar presented last year, and this one is in addition to that with a different angle. So welcome. Let's start by seeing if you can all use the question box or the chat box. So question is, what is the best time to visit Japan for the cherry blossom season? Please give me an idea. What do you think? Beautiful time, some beautiful photos, although I don't think provide or convey the beauty. So on the right hand side there's a question box. Please let me know. What do you think? So I've got April. I've got most people April, any other ideas? Spring, Dion, that's a cheeky one. April, March, no idea. Winter, looks like most people have it as April. So let's see. So if you do a little bit of research, which I've done, they say it's quite difficult to determine what's the best idea. However, April, and they are predicting that the peak of these cherry blossoms will be on April the 7th this year. So if you want to do some traveling, that would be a good time to visit Japan. So on the right hand side there's a question box. Please let me know some of your answers, your thoughts, your questions as we go along. So the roadmap for this session, we start with an introduction, and then we look at identifying a business combination. And then in number 3, we look at accounting for a business combination in the records of the acquirer. We'll also look at accounting for subsequent adjustments to the initial accounting. And then we'll also look at some disclosures. So that's the roadmap for today's session. If we start with an introduction, the reference materials first of all. So in Australia it's AASB 3. Internationally IFRS 3, and obviously New Zealand IFRS 3. So why do we have a specific standard dealing with business combinations? Why would business combinations be such a big thing? I suppose practically, if you don't have a business combination, you'll never get to consolidated financial statements. So that's a starting point for the need to prepare consolidated financial statements. But really it's about the needs of the users of financial statements. And that's that the users of financial statements are very likely to find the information about new business combinations important. Because that would have, as a result of a business combination, there would be some expectation of future potentially long-term returns on that investment. So users quite interested in business combinations in the same way they're interested in discontinued operations. So those are quite significant events in the life cycle of an entity. So there, I've referred to it earlier. If you want to look at the previous webinar, it doesn't consider or contain the same content. There are a lot of examples in there about step acquisitions and sale of interests and how we account for that. And you can also look on YouTube if you're interested in that. So let's start with identifying a business combination. Now this little part 2, identifying a business combination, is similar to that webinar because we have to get some common ground of what is a business combination, what are we talking about. And this is actually in my experience, the hardest part of business combinations. So what is a business combination? A business combination is a transaction or other event in which an acquirer, emphasis on acquirer, obtains control, and another emphasis on control, of one or more businesses. Now what is a business is the critical aspect. So yes, we have to identify an acquirer. Yes, we need control. But it's, have we acquired an asset? Then AASB 3 won't apply. Or have we acquired a business? And if it's a business, then we apply AASB 3, and then we use the acquisition method. So that whole concept of a business is crucial. By the way, what about control? How do we know what is control? Remember, there's a new internationally IFRS 10 and in Australia AASB 10, which is looking at a new definition of control. So we're no longer looking at a share interest of more than 50% of the shares. We're considering a number of factors. We are considering who has the power over the investee, are exposed to returns from that investee, and has the ability to use their power to impact those returns. So that definition of control, or this reference to control here, is a reference to control as defined in the new IFRS 10 and the new AASB 10. I think an important point to make is that transactions that are often referred to as true mergers or mergers of equals are also business combinations. So this standard is not only dealing with a clear acquirer obtaining an acquiree, it's also dealing with a situation where two businesses come together, and a lot of people talk about that as true mergers or mergers of equal. And in the old days, a long time ago, we didn't use the acquisition method for those situations. We used pooling of interest method, which is long gone. However, they're saying true mergers, mergers of equals, are also a business combination in terms of the standard. So what are examples of business combinations? When would you see it? When should you start thinking about applying the standard? If one entity is purchasing another entity by acquiring its equity, by acquiring its shares. So one entity is buying 60% of the shares, issued shares of another entity. It could be one entity purchasing a business from another entity. So we are buying a business, we're not buying shares, we're buying a business, we're buying a collection or a group of assets and liabilities, and we're ripping out that part of your business, including it into our business. That's also a business combination. We could also have the merger of two previously unrelated entities, so mergers are within the standard. And we can also have a situation where we establish a new entity to control two previously unrelated entities, and again, that's also captured within the standard. So what constitutes a business? And that's a real key thing to consider, because if it's not a business, it's not within the scope of the standard. And a business is defined as an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividends to the shareholders, lower costs where we work together, or other economic benefits. So it's quite wide. Other economic benefits, any economic benefits directly to investors or owners, members or participants. The interesting thing here is it is the reference to capable of being conducted. So it doesn't currently have to be conducted as a business for these purposes, but in future it is capable of being conducted for this purpose. What's very important, it's not necessarily the current use, but the capability. Definition of a business. So very important. Why is the definition of a business so important? because the definition of a business is the first hurdle that you have to pass in order to apply acquisition method of accounting in terms of the standard AASB 3. So do the assets acquired and liabilities assumed constitute a business? If you say no, it's a normal asset acquisition. If you say yes, then it is a business combination. We apply AASB 3 and it would mean the acquisition method. Right? So very important to pass that very first hurdle. The other thing to consider, or the second hurdle really, is are the acquirer and the acquiree, just a second, I just want to check, there's a question coming through. There's a question about sound. Joseph, I think the problem is on your side. Could you please check with your IT? I hope you get that fixed. Sorry. I think what's important here is that you've got the first hurdle to pass to get to the application of the standard. So if you've acquired the business, there's a very important second hurdle to pass, which is often overlooked, and that is, are the acquirer and the acquiree under common control? And if we say no, then you can go ahead and apply AASB 3. If you say yes, we have to consider further things. We have to think about it. If you say it's a common control transaction, you would not necessarily, you wouldn't automatically apply AASB 3. You'll have to think about this one. Because if it's under common control, an example of common control that I just want to show you first, and then I'll consider the implications. So what is common control? The most simple version of common control is if we've got a parent with two subsidiaries, and subsidiary B have two subsidiaries of its own, and subsidiary C have a subsidiary. In this situation, if subsidiary B purchase subsidiary F, and ultimately both of those entities are controlled by the same parent, if we assume that I mean, obviously if it's control, if it's a subsidiary, there's control. So if subsidiary B would purchase subsidiary F, as a result of that transaction, we should not be recognizing goodwill or gain on purchase. We should not be fair valuing assets and liabilities at that date, because we are transacting within the same group. We're not transacting with third parties. Therefore, we shouldn't get the benefit of adjusting or uplifting assets to its fair value. We should not recognize goodwill. We should not recognize a gain. However, this is a tricky thing, common control, because if we say, listen, AASB 3 is not appropriate, so what do we have to do? IFRS 3, AASB 3 scope out common control transactions. But then what do? Now, some people argue, you have to look at the closest possible standard, which is the standard. So there are different views, and in my reading and research, I found the following, and that is that you have to consider, if we go back to the previous slide, you have to consider, if you get to the situation that it's common control, you shouldn't automatically apply AASB 3. You should consider whether it would be appropriate. So when evaluating whether that transaction has substance, if the transaction has substance, you'll apply AASB 3. When evaluating whether that transaction has substance, you will or should consider the following things: the purpose of the transaction, and the involvement of outside parties in the transaction, such as non-controlling interests or other third parties. And because if there are outside parties involved, one would say, okay, maybe we should be applying AASB 3. Whether or not the transaction is conducted at a fair value, or is it just at carrying amounts. So again, if it's at fair value, one would say, okay, possibly consider AASB 3. We should consider the existing activities of the entities that's involved in the transaction. We should consider whether or not it is bringing entities together into a reporting entity that maybe didn't exist before. You know, so yes, and where it's a new company that's established, we have to consider whether it is undertaken in connection with an IPO or spin-off or other change of control or other significant change in ownership. So it's not an automatic apply AASB 3. It is consider the substance and consider a number of factors. I think I wanted to start the session similar to the previous webinar, where we just make sure that we've got a business. We make sure that this business acquisition is not under common control, and if it is under common control, we consider whether AASB is appropriate. When AASB 3 were first issued a number of years ago, I think everybody was a bit over-eager to apply the standard, and I think the risk at the moment is that maybe we're applying it in inappropriate situations. So before you go into the details of AASB 3, did the acquirer buy a business? And if yes, are the acquirer and the acquiree under common control? And if you say no, yes, apply AASB 3. If we move on to Section 3, in Section 3 we are looking at accounting for business combination or for a business combination in the records of the acquirer. Now, whenever I see the word records, I don't think of financial statements or trial balances or general ledger. I think of the old records of the old days. But anyway, that's just me being silly. So what is the core principle of AASB 3 when we look at that initial recording of the transaction? And the core principle is that an acquirer of a business, and again it talks about a business, an acquirer of a business, it needs to be a business, recognizes the assets acquired and the liabilities assumed at their acquisition date fair values. So even if the acquiree is accounting for these assets at historical cost, the fact that you've got a business combination means you can reset for the purposes of your business combination and in future for consolidated financial statements. You can reset that historical cost to a new acquisition date fair value. It doesn't change your accounting policy to a policy of revaluation. It is a reset just at the date of acquisition. And we will disclose information that enable users to evaluate the nature financial effects of the acquisition. So the whole thing that we should never forget about accounting, it's about providing useful information to users. And we want to say, as a result of this business combination, these were the fair values of what you've purchased. This is what you've paid. Was it a good deal or not? So if we look at the acquisition method, remember, if we apply AASB 3, we apply the acquisition method. The acquisition method has 5 distinct steps in it. Now, in the standard, there are only 4. I've split the standard step 3 into step 3 and 4 because I find it easier to manage it that way. So I've just broken it down into 2 subsets. So I've got 5 steps. Number 1 is identify the acquirer. Number 2 is to determine the acquisition date. Why is that so important? Because at that date we're determining the fair value of the consideration, the fair value of the assets and liabilities acquired, and the value of goodwill. In step 3, we recognize and measure at acquisition date those assets acquired, liabilities assumed, as well as non-controlling interest in the acquiree. So if we've got the wrong acquisition date in step 2, what we do in step 3 would be wrong. In step 4, we measure the consideration transferred, and then finally in step 5, we recognize and measure the goodwill or the gain from a bargain purchase. So those are the 5 steps. So let's work through these steps, and I've included a few examples along the way. Step 1 is to identify the acquirer. AASB 3 has recently been amended, and it says the guidance in AASB 10 consolidated financial statements shall be used to identify the acquirer, so IFRS 10. So the definition of control in IFRS 10, AASB 10 should be used, nothing else. And then it says the broad principle is that the entity that obtains control of another entity, the acquiree, is the acquirer. So it's about control, it's about this new definition of control in IFRS 10 or AASB 10. If you want to look at a webinar on IFRS 10 or AASB 10, I've recorded one at the beginning of last year, January or February, and it's also available on YouTube. Step 1 still. If a business combination has occurred, but when we look at the guidance in AASB 10, it does not clearly indicate which of the combining entities is the acquirer. The factors that we've got in AASB 10 in paragraphs B14 to B18 should be considered. So first of all, and that's important, first of all you go to AASB 10 and determine whether you can you see who's the acquirer or not, and only if it's not clear, then you go to the appendix B of AASB 3, and you look at a number of factors. So what are those factors? Now, these factors should not be looked at in isolation, but you should consider all of them, put it on the balance of facts, which entity is the acquirer. So a few examples or the items listed. So which entity is transferring cash or other assets or incurring liabilities? So usually the entity that's paying cash or is paying or with other assets or incur a liability in order to settle a purchase price, usually they're the acquirer. Another thing to consider, which entity is issuing equity interests? So which entity is issuing shares? You should also be looking at the relative voting rights in that combined entity after the business combination. So which entity has the biggest proportion of the voting rights? The other thing is to consider if there's the existence of a large minority voting interest. So it's a relative shareholding. So it comes back to that concept of de facto control. We also look at the composition of the governing body of this combined entity. So who is appointing the chairman, majority of directors, majority of people on this governing body. We also look at the composition of senior management in the combined entity. So although we could look at all the other factors, but maybe one entity appoints all the senior management of the other entity. And therefore, they could be deemed to be the acquirer. Remember, it's a balance of facts. We look at the terms of the exchange of interests. We look at the relative size of the combining entities. If the one was really huge and the other one was fairly small, based on net assets, maybe the bigger one would be the acquirer. And also, something that you could consider is which entity initiated the combination. So it's a number of things to put on the table and then decide who has control. So who is the acquirer? So your first thing is go to AASB 10 and see if you can determine who is the acquirer, who has control. And if it's not clear, then you go and you look at Appendix B of AASB 3 and consider all these factors. The second step, why is the correct determination of the acquisition date important? So the second step is to determine the acquisition date. It's because the following items must be recognized and measured at the acquisition date. The consideration that you've transferred, all your identifiable assets acquired, all the liabilities assumed, any non-controlling interest. And if you've got a step acquisition, or that is a business combination achieved in stages, any previously held equity interest owned by the acquirer should now be stated at fair value. So recognized and measured at fair value. That last bullet point where we've got achieved in stages or step acquisition, the previous webinar I had an example of that, could lead to quite significant profit or loss in the records of the acquirer. So if you've purchased a part of this entity a number of years ago at a really cheap price, and now you're buying the rest in order to get control, you can recognize quite a big profit on that initial investment. So that is an interesting change that came through a number of years ago, say 7, 8 years ago, which could lead to a bit of volatility in profit and loss. And then something that should be considered in step acquisitions, and it was a fairly new and controversial change to the new AASB 3. So if we determine the acquisition date, we now know it's important. How do we determine it? So acquisition date is the date on which the acquirer obtains control of the acquiree. So when do the acquirer get the control? So usually the acquirer would get control when the acquirer legally transfers the consideration. So whatever we have to pay, we legally transfer. If we have to issue shares, etc., that's when it happens. And also the date that the acquirer legally acquires the assets, assumes the liability, or the closing date. Right? So it's about that legal transfer of consideration, assets, liabilities. It could be that due to a written agreement, control is obtained at another date, and therefore we should consider that. You should not only look at the legal transfers, but if there's a written agreement that give them control at another date, that should be considered. And an acquirer shall consider all the facts and circumstances to identify an acquisition date. I've seen some transactions where the acquisition date or the decision on the acquisition date had quite a significant impact on the transaction and the goodwill or the gain recognized. Because if the one entity had to issue shares, there was a significant difference in the fair value of the shares issued by the acquirer between the two different options that we were considering. So this could be a sticky thing in practice. In step 3, now we get down to the calculation part of it. We've identified the acquirer, which can be tricky. And when we identify the acquirer, we should kind of, in the back of our mind, consider, is it a potential reverse acquisition? Step 2, we've considered the date of acquisition. Date of acquisition, we have to be careful. So when what's the date of control that passed from the acquiree to the acquirer? And now we get to step 3. We've got that sorted out. Now we have to recognize and measure at acquisition date the identifiable assets acquired and the liabilities assumed, and the NCI in the acquiree. NCI, non-controlling interest. The standard says or sets out some general recognition principles, and then go on to list a number of exceptions. So there's a general recognition principle, but there are also a number of exceptions to this. So what is the general recognition principle? So as of the acquisition date, the acquirer shall recognize separately from goodwill the identifiable assets acquired, the liabilities assumed, and any NCI in the acquiree. Now, the identifiable assets acquired and their liabilities assumed must meet the definitions of assets and liabilities in the framework at the acquisition date. So if you think, you cannot start to create all kinds of other things, it has to be an asset in terms of the framework. So it's something under your control as a result of a past event that would lead to an outflow of future economic benefits. And a liability is a number one, a present obligation, number two, at reporting date, and that as a result of past events, number two, and number three, that would lead to an outflow of future economic benefits. So important, we recognize identifiable assets, we recognize liabilities assumed, we recognize non-controlling interest, but the assets and liabilities should at least meet the definition of an asset and liability in the framework. That doesn't change. If you look at general measurement principles, they say the acquirer shall measure those assets acquired, liabilities assumed at their acquisition date fair values. So assets and liabilities in a way are fairly easy. It's fair value. In practice it's hard. Often we have the transaction, and as it happens, these transactions are always just before year end. So the transaction happens, and we have to get valuers in to come and determine the fair values of assets and liabilities. So often we have provisional accounting at that first reporting date, and then once the valuers come in with the final numbers, we update those provisional numbers. So that's a general principle. The interesting one is the following one, which is a bit of a combination of IFRSs and what America had in the past, because it now says that an acquirer can choose to value NCI at either fair value, which we call the full Goodwill method. So it could be fair value, or the full Goodwill method, or the old America approach, or that's the approach they had in America. And now, or the other method which we've always had in Australia and most countries internationally, definitely always been in IFRSs, is a proportionate share, so it's a percentage of the recognized amounts of the acquiree's identifiable net assets. So we call it the partial Goodwill method. So it's either fair value of NCI, or it is a percentage of the net assets of the acquiree. So that's the two options, and you can decide. The acquirer can choose which one to use. You can see here that these two amounts are not always the same, and in the standards they consider situations on why it would be different. So maybe the fair value of that last 10%, so we've got 90%, that last 10%, maybe the fair value is really high, because if we get to buy the last 10%, we can form a tax consolidated group which has certain benefits in Australia, therefore that fair value is quite high. In other examples, the fair value could be low. So let's say we've got 90%. Let's say there's no incentive to go to 100%. It's really just you've got control. You don't want anything more to get control. You already have control. So the fair value of that remaining 10% could be quite low. So that's where we get the valuers involved, and they determine the fair value of NCI. The percentage of net assets is what we used to have in Australia. So let's look at an example. So in the first example, let's say entity A buys an 80% controlling interest in entity B. So I'm telling you the 80% will give you control in terms of AASB 10. And it pays $150 for that 80% interest. And at the date of acquisition, the fair value of the assets of entity B is $120, and the fair value of entity B's liabilities is $40. Now, a valuer determined that the fair value of the non-controlling interest at date of acquisition is $50. Now, question, what is the value of the NCI at date of acquisition? Now, at this stage, I want to start a poll. So question, I want you to vote. I've given you a few options. So question is, what is the value of the NCI at the date of acquisition, and I've given you 4 options. So please vote. Let's see. So you've got the information. What do you think is the fair value? Come on. Only 20% of the attendees have voted. I think at last count, we've got nearly 200 people attending the webinar, so I would like some more people to vote. So what is the NCI at date of acquisition? All right, thank you very much. So at this stage, 35% of people voted, 36%, and 46% is saying, let me just see if I can maybe display it. Oh dear, what have I done now? That's when I'm trying to be too smart. Oh dear, what happened to my slides? Do you think I'll ever get them back? Oh, they're back. I'm sorry. I'm trying these polls. I haven't used them for a while. All right, 40% of people voted. 44% says NCI is 50. 26% says NCI is 16. I've got 13% that's saying 20 and 17% saying 30. All right, so quite interesting. Quite interesting. All right, so I think you can see the final results there. Very interesting. Looking at that, I checked the question box because I've expected you to say to me, Aletta, there are 2 options. They've got a choice. You haven't told us what their accounting policy is. All right, and I did that on purpose. So the 2 correct answers here could have been 50 if they've used fair value, or it could have been the 16. So let's have a look at that. I just want to close this up. So how on earth do you, I get it away. Are we back at slides now? Right, I'll tell my children, Mum's been a risk taker today because I've tried these polls. Anyway, I'll get better at it. If we move on to the suggested solution, so if entity A chose the fair value method, NCI would have been 50. But if entity A chose the proportionate share of net assets, they would have said NCI is 20% of the net assets of entity B, which would be 20% of 80, which would be 16. So the fair value method is what they used to use in America. The proportionate is what we've used or used to in Australia, but you could choose either. So both would have been correct. So I'll continue with that example a bit later to show you how that impacts goodwill. It's got some interesting implications. So let's look at, remember we've started with the general recognition principles and the general measurement principles, but there are a few exceptions. One of the exceptions relate to intangible assets. So the acquirer shall recognize separately from goodwill the identifiable intangible assets acquired in this business combination. So, you know, in the old days, before we had this new AASB 3, people didn't put a bit of effort into identifying intangible assets. They said, you know, why bother? We just take the easy assets, the assets we can identify easily, the liabilities, and all the rest we lump together within goodwill. Now these days, we have to try and identify intangible assets separately from Goodwill. And if you can do that, it's actually good for you, because Goodwill, you have to do an annual impairment test. And if your Goodwill number is too high and you've not done all the hard work at the date of acquisition to identify all the various intangible assets, you could run into impairment problems. So it's important to try and identify all identifiable intangible assets. And then, intangible assets based on their useful life, whether it's, you amortize it over its expected useful life, and if it has an indefinite useful life, you do an annual impairment test as well. So important to do that. The other thing is, an intangible asset is identifiable if it meets either the separability criterion or the contractual legal criterion. Now, important to note here, if you want to recognize an intangible asset in terms of AASB 138 intangible assets, the recognition criteria talks about it should be measurable, the cost should be measurable, and it should be probable that there are future economic benefits. Here in AASB 3, they're not talking about probability. All right? If you look at recognition, they're just talking about separately identifiable intangible assets. Therefore, after the introduction of this AASB 3, it led to the recognition of a number of intangible assets at the date of acquisition, where those intangible assets would not normally be recognized in the financial statements of the acquiree. And remember, this business combination does not change anything that happens in the financial statements or the financial records of the acquiree. AASB 3 is just concerned about business combination in the records of the acquirer. We cannot go and change the records of the acquiree. So the acquiree in their records don't have intangible assets because they don't meet the recognition criteria in AASB 138 or IAS 38. However, when the acquirer account for the business combination and try and determine a goodwill as a result of the business combination, they do include intangible assets. And they do place a fair value on them. So that's one of the exceptions. The other thing is around contingent liabilities. Now, for contingent liabilities, it says we recognize contingent liability as of the acquisition date if we've assumed it in a business combination. So when would we recognize this contingent liability? If it is the present obligation that arises from past events, and the second thing, and its fair value can be measured reliably. Again, if you look at that, it talks about a present obligation, past events. It doesn't talk about probability. So usually, probability is a recognition criteria for intangible assets, for liabilities. Here it says no. Even if it's not probable, even if it's less than 50% probable, we'll still recognize the contingent liability if we can measure the fair value. And remember, you can measure the fair value, you make an estimate of the fair value. It's a cop-out to just say I can't determine the fair value. We have to honestly try and come up with a fair value. So, important, the acquirer recognizes a contingent liability assumed in a business combination, even if it's not probable that there will be an outflow of resources. So, for instance, if there's a contingent liability, let's say there's a court case against the entity, and they're suing us for $100. In terms of AASB 137, if we set the probability of that court case coming to fruition and we're paying $100 or being told to pay $100 is, let's say, 20%, we would not recognize a liability as an acquiree because it's less than 50%, it's not probable. However, when an acquirer comes along and looks at this business combination, the acquirer would say, we have assumed this potential liability, Although it's not probable because it's just 20%, we can measure a fair value, and let's say the fair value is 20% of 100, so it's 20. We should, in our business combination, account for that 20, and that should impact our goodwill or our gain on acquisition. So for business combination, when we get to intangible assets, when we get to contingent liabilities, it's not about probability. It's not that less than 50%, more than 50%. It's about fair value. Another example that I want to look at, or an exception to the general recognition and measurement principle, is income taxes. Now, the acquirer shall recognize and measure a deferred tax asset or liability arising from the assets acquired and liabilities assumed in a business combination in accordance with IAS 12 or AASB 112. Now, deferred tax assets or deferred tax liabilities are recognized where the carrying amount of the assets and liabilities differ from their fair values at date of acquisition. Now, this is often the case. In the carrying amount of the acquiree, they've got assets at historical cost, if it was their policy to carry property, plant, and equipment at historical cost. Now the acquirer come along, and for purposes of the business combination, they determine fair value of those items. Remember, the acquirer cannot change the records of the acquiree. The acquiree is happily going on with the carrying amount of the assets in their financial records. The acquirer says, hang on, for my purposes, the fair value is the following, and on that adjustment from carrying amount to fair value, there's a deferred tax implication. I want to show that or illustrate that through an example. So let's say entity A buys an 80% controlling interest in entity B for $150, and at the date of acquisition, the fair value of the assets of entity B is $120, and the carrying amount and the tax base of these assets are $100. So the tax rate is 30%. Question, what journal or journals should be processed on consolidation in relation to these assets? So the assets are in the records of the acquiree at 100. For business combination purposes, the fair value is 120. The acquiree does nothing with this information. But the acquirer, for business combination purposes and for consolidation purposes going forward, would account for these assets at the 120, at the fair value. So how do we do that? What are the journal entries? I'll give you a second to think about that. All right, so what do you say? What are the journal entries? So I've said, on acquisition, the acquirer will say debit assets. Remember, it's the assets of entity B, the acquiree. We're not doing it in the records of the acquiree. The acquirer in their records on consolidation, accounting for this business combination, will say debit the assets of 20 and credit the business combination revaluation reserve of 20. So we increase the assets from carrying amount to fair value, and we create this business combination revaluation reserve. Have any of you ever seen a business combination revaluation reserve in a set of financials? I would say no, because on consolidation that is eliminated against the cost of the investment. The next step, however, after we've revalued the asset, is we have to say, okay, we now have to create a deferred tax liability. Sorry, it's the 20 times 30%, not 12 times 30%. That's a typo. So the deferred tax liability would be the 20 times 30%, which is 6. So we debit the reserve and we credit the deferred tax liability in the balance sheet. Remember, the deferred tax follows the originating entry because the original entry went through a reserve. the deferred tax would go against the reserve as well. So how did I get that deferred tax? I did the normal calculation in IAS 12 or AASB 112, where I said if you look at assets collectively, the carrying amount of the assets in the records of the acquirer is now 120. The tax base has not changed. Remember I said initially the carrying amount in the tax base was 100. If you have a business combination and you buy these assets and the fair value is 120, the tax office couldn't care less. The tax base and whatever future depreciation you get for tax purposes will be based on the 100, definitely not the 120. And therefore, that difference between the carrying amount, the new carrying amount, and the tax base would give you a temporary difference. So in future, conceptually, your future economic benefits are 120. For tax purposes in future, you get a deduction of 100. Therefore, there's a temporary difference, a taxable temporary difference of 20, and therefore we create a deferred tax liability, a DTL. So very important that for every asset where we adjust the value, or for every liability where we adjust the value or bring in a new liability, we should consider the deferred tax implications. Now step 4. In step 4, the consideration transferred is measured as the total of the acquisition date fair values of the assets that's transferred by acquirer. So it could be I've paid in cash, it could be I've paid through the transfer of other assets. It's the fair values of liabilities incurred by the acquirer to the former owners of the acquiree. So I'm buying this and I have to go and borrow money to pay it. And then also the equity interest issued by the acquirer. So often the acquirer would issue shares to the previous shareholders of the acquiree. Important that the fair value of the assets, the liabilities, the equity interest, everything here would be determined in terms of IFRS 13 or AASB 13. And we've done a webinar on IFRS 13, AASB 13, I think in March last year, if you want to go and look for that. So a part of the consideration that's transferred could be deferred. So let's say we'll pay some money now and a portion in 12 months' time or 24 months' time. So it could be plain deferred, and then we have to come up with the fair value of that deferred consideration. And the fair value for the deferred consideration would be included in our consideration number. The other thing is that consideration could be contingent. That future consideration could be contingent on a particular event. So we want the previous owners to stay involved in the business. If the business, after the business combination, continue to meet certain profit targets or reach a certain share price, we'll pay a certain consideration to them. So it's a contingent consideration, and again a fair value will have to be determined and included in our consideration calculation. The other thing is to remember that transaction costs will not be part of consideration or taken into account when we look at consideration, calculation of goodwill, etc. Transaction costs, acquisition-related transaction costs, are expense in the period in which they incurred. And I've given you there some examples of what transaction costs are. There's one exception, and that comes out of IAS 32 or AASB 132 in paragraph 35, which says that the cost of issuing debt or equity will continue to be offset against the proceeds in accordance with IAS 32 or AASB 132. So important to keep that in mind. In step 5, we now recognize and measure the goodwill or gain from a bargain purchase. And the way to do it, and this is always the case according to IFRS 3 or AASB 3s, it's the fair value of the consideration transferred. So that's what we've determined in step 4, the fair value of the consideration transferred. It could be deferred, contingent, cash, etc. fair value of the consideration plus the value of the NCI, which we determined in step 3. And remember that value of the NCI could be fair value or it could be proportionate share of net assets, either or. And then the third one is if you've got a step acquisition, it's the fair value of the acquirer's previously held equity interest. And so that part is not always present, it's only for step acquisition. And then from that we deduct the acquisition date fair value of the identifiable net assets, which we've determined in step 3. So all the assets less all the liabilities would give us the identifiable net assets. Remember, it would include these identifiable intangible assets. It would be including contingent liabilities at fair value, and that would give us goodwill. So this is the formula. Therefore, in my example, and this is a continuation of example 1, I've used the same facts as example 1. So this is actually the information from example 1. That is the solution. We said NCI could be 50 or NCI could be 16. So now the question to you, well, first of all, if we look at the full goodwill method, remember full goodwill method, your NCI is at fair value. I said if we have NCI at fair value, what would goodwill be? So fair value is of the consideration is 150. The value of NCI fair value is 50. It was not a step acquisition, so that's not applicable. So less the acquisition date fair value of identifiable net assets. Remember, I told you that assets was 120, less liabilities of 40. Therefore, identifiable net assets is 80 and goodwill is 120. Therefore, if the value of NCI is at fair value of 50, then goodwill is 120. So question to you, what would the goodwill be? What would the goodwill be if the value of the NCI is 16 and we use the partial goodwill method? So what do you think? What's the value of the goodwill? If you use the formula on the slide, you use the NCI for the partial goodwill method as 16, what would the value of goodwill be? Again, we've got around 200 people, have only got 17% have voted. Come on, please vote. It's important to vote. All right, we're creeping up to around 25%. Come on, what do you think? So let's look at the results. So in this situation, 64% of the people that voted, and it's about 30% that voted, we've got 64% says your goodwill is 86. 10% said 120, 102, 80. All right, so let's see. So if we go back to our slides, next slide, where I've got the solution, and the answer is 86. So most of you got it right, fantastic. So fair value is 150. The value of the NCI is now a proportion of the net assets, which is 16. Acquisition date fair value is 80, and therefore our goodwill is 86. So you can see if The NCI is 16. We've got Goodwill of 86. However, if the Goodwill is, or if the NCI goes up to 50, Goodwill goes up to 120. Because Goodwill is an asset, NCI obviously is equity, it's a credit balance. So if Goodwill is higher, if NCI is higher, your Goodwill is higher. So there's a relationship between the two, just to contrast the two methods. Still part of step 5, please note that where there is a gain from a bargain purchase, the acquirer should reassess the amounts that they've recognized and measured in steps 3 to 5. So are we happy that we've identified all the assets, liabilities? Are we happy with their fair values? Are we happy with the consideration? Are we happy with the fair value of the consideration? So we don't want to recognize this gain. We want to make sure it is a gain, because any gain after this reassessment is immediately recognized in profit or loss attributed to the acquirer. So we're really careful before we recognize this gain. We double check. If we move on to section 4, where we look at accounting for subsequent adjustments to the initial accounting, we talk about measurement period adjustments, and that is that Goodwill or your gain from a bargain purchase must be adjusted when subsequently you receive new information. It becomes known that, 1, the consideration transferred needs adjusting, so that could be you adjust the probabilities around your contingent consideration. Initially you thought there's a 60% probability, and now you realize there's only a 20% probability. So it's contingent consideration, it could be deferred consideration, sorry, it can't be deferred, it's contingent consideration, or if there are assets and liabilities in existence at the date of the acquisition and we didn't recognize them. So maybe when the valuers look at all the assets and liabilities, they identify additional intangible assets. And then the last one, they could come up with different fair values. They gave us provisional fair values of assets, liabilities. And now when they look at it and they give us the final numbers, those fair values are different. So measurement period adjustments is to acknowledge the fact that to come up with fair values is not an easy task. It doesn't happen quickly, and it gives us some time. So the measurement period is the time to make adjustments to Goodwill and bargain purchase, or your gain from bargain purchase. So what is the measurement period? How long do I have to finalize these numbers? It ends as soon as the acquirer receives the information that it needs to do this business combination accounting, or it acquires more information that was previously not obtainable. And very important, this measurement period cannot exceed 1 year from the acquisition date. So really you've got a maximum of 1 year to finalize all assets and liabilities, fair values of assets and liabilities. So why do we want to do it within the measurement period? Because if we make adjustments within the measurement period, it impacts Goodwill or the gain from bargain purchase. After the measurement period, it impacts your profit and loss. And usually we don't want that kind of volatility in our profit and loss. We'll rather make the adjustments against Goodwill or gain at acquisition. When we look at the disclosures, if you look at an overview of the requirements, they say the acquirer shall disclose information that enables users to evaluate the nature and the financial effect of a business combination that occurred during the reporting period or after the end of the reporting period, but before the financial statements are authorized for issue. So subsequent, so business combinations after balance sheet date, but before we sign the audit report or the director's declaration has to be included, and information has to be disclosed about it. Very important. Doesn't stop at balance sheet date. The other thing is the acquirer shall disclose information about adjustments recognized in the current period. Remember, we've got a measurement period. So in the current period, we could make adjustments to a business combination that happened in the previous period. And therefore, we have to disclose the nature of those adjustments. So if we've adjusted goodwill in respect of a business combination that happened last year, we have to disclose it. AASB 3 has a lot of details, lists of things that have to be disclosed, and I've not repeated this. These are the two overarching requirements, and the exact details you can look in AASB 3. So why do we have these extensive disclosures? You know, business combination is very significant to the economic entity, and also it could impact the anticipated long-term benefits that users expect from this entity. Therefore, important to disclose all the relevant information. 6 minutes past 3. I'm sorry I've gone over time yet again. 6 minutes, I get overexcited. Thank you very much for joining me. We looked at those 5 parts of AASB 3. Please send comments or questions through. You can also email it to me. Thank you very much. Have a great weekend.